Welcome to part 2 of the EA Tax Training Enrolled Agent Exam Preparation course. My name is Tom Norton. I am both a certified public accountant and an enrolled agent, and I will be your guide and instructor throughout this course. Part 2 of the EA exam is all about business taxation. We've got 9 videos for you in part 2. The first video you're watching now is about business entities and getting started. Video 2 is about accounting methods and business income. In video 3, we'll talk about assets and depreciation. Video 4 is about deductions and credits. Video 5 will cover sole proprietorships and partnerships. In video 6, we'll talk about C corporations, and in video 7, we'll talk about S corporations. And then videos 8 and 9 will cover specialized topics. As always, I look forward to guiding you through all of these topics. One reminder, the 2024 EA exam covers the 2023 tax year. So if you're studying for the 2025 exam, you'll want to take note of the inflation adjustments that apply to some of the dollar figures you see in the tax law. So without further ado, let's jump right into video 1, business entities and getting started. Here's what we'll study in this video: types of business entities that you'll be dealing with in doing tax returns, getting started with a business and the requirements of what you need to do, reporting requirements for a business other than just the regular income tax return, and then we will talk about worker classification. As always, we've got free resources available from irs.gov. So if you were with us with part 1 of this course, you know that for every one of these videos, we put up a free resources slide that shows you where you can find IRS publications, forms, and form instructions that are related to the material in that video. And this video is no different. So what you'll notice are that these are all publications. We don't have any forms or form instructions for this particular video, but we do have several publications that you will want to get a hold of and that you will want to study. Remember that the EA exam questions come primarily from IRS publications and form instructions. So these publications and the form instructions actually have all of the answers to the EA exam questions if you know where to look. So obviously the purpose of these videos is to give you an overview of the different areas that are covered by the exam and point you to those areas that you will want to study in those various publications and form instructions. So let's start with types of business entities. What you will want to know, first of all, is there are various types of entities that can operate businesses and that can be taxed. There are some entities that are, in fact, legal entities under state or common law, but are not recognized as taxable entities under the tax law. And conversely, there are some entities that are recognized under the tax law that are not actually legal state or common law entities. And it is important to know the difference and to understand what we're talking about here. So if you look at this list, we start at the top with a sole proprietorship, and we're going to go into each of these a little bit more. But sole proprietorship you have under both state or common law and under income tax law. Same way with partnerships. Then we get down to qualified joint venture. This is a tax concept, not a state or common law concept. And you'll notice here with the 2 asterisks, we say not technically a separate tax entity, but does receive special tax treatment. So we will talk about the qualified joint venture here in a little bit. Next, you have a limited partnership and a limited liability partnership. Those are both state law entities, but they're not income tax entities. So we will talk about those. But for income tax purposes, those would just be classified as a partnership. So they are not specifically a limited partnership or a limited liability partnership for tax purposes. Then we have a corporation, which is, of course, a state law entity, but there is no just plain old corporation income tax entity. For tax purposes, every corporation is either a C corporation or an S corporation. But those concepts, C corporation and S corporation, are not recognized under state law. So when you go to form a corporation, you just form a corporation with your Secretary of State's office. You don't specify if it is a C corporation or an S corporation. But for tax purposes, you don't have just a plain old corporation. You have one or the other, either a C corporation or an S corporation. And then finally, we have the limited liability company, which is a state law entity. It's formed, again, with your state's Secretary of State's office, but there is no income tax entity called an LLC. So there is no LLC tax return. An LLC instead will be taxed as one of these other type of income tax entities that are recognized by the IRS. So now let's talk about briefly each of these types of entities, and then we will go into more detail about them in later videos where they have their own videos that are dedicated to explaining all of the various tax consequences of each entity. So first, sole proprietorship. This is a single owner entity that is not incorporated. So, in other words, you don't go to your Secretary of State's office and file anything. You don't have to file as an LLC or a corporation or anything like that. You can just start doing business. Now, if you do business under a name other than your own personal name, then you may need to file with your state Secretary of State's office a fictitious name or DBA, doing business as form. It just costs a few dollars. You're not creating an entity with that. Instead, you're just letting the state know and letting the public know that you, let's say your name is Mary Smith, that you, Mary Smith, are doing business as Smith Bookkeeping, for example. So you would file that fictitious name registration or doing business as registration, but you're still just a sole proprietorship. And you might also need a business license from your city or county where you live. But again, you're not forming a separate entity, you're just getting a license in that case. This is the simplest way to do business. You want to be a sole proprietorship, especially if you're not going to use a name other than your own name. You just start doing business. Of course, you always want to see if you need a business license or not. But in any case, this is the easiest way to get into business. You can basically just start doing your business, and there is nothing else to do. The biggest downside here is liability. If you get sued, all of your personal assets are at risk. So one of the big reasons that people go and form a corporation or an LLC is in order to protect themselves from liability so that only the entity can get sued and they personally cannot get sued for the things that the business does. So if you don't have one of those type of entities, you're just a sole proprietorship, then you can personally get sued for what the business does. Now, some people really freak out about that, but the fact is, for most types of businesses, you can offset most of that risk, at least, with a business insurance policy. You can go out and get a general liability policy, or for other types of businesses, you might get something called errors and omissions insurance. But in any case, you can usually find an insurance policy that will protect you in case someone sues you. But there is still this other risk of your personal assets being at risk in case you get sued. If you have a sole proprietorship for income tax purposes, you report that on Schedule C of Form 1040. Or if you're a farmer, then you would report it on Schedule F. But the point is, there is no separate tax return that needs to be filed like there is with a lot of the other types of entities. So you just file your regular income tax return, your Form 1040, just like you always do, and then you add to it this Schedule C, and you may have to add another form or two as well, depending on the circumstances of your business. And then the income from that sole proprietorship is taxed at your normal personal income tax rates. All of your income, also, if you have positive income, in other words, if you don't have a loss, is subject to something called the self-employment tax, which is a substitute for Social Security and Medicare. Since you don't have a job where they withhold Social Security and Medicare, you instead pay this self-employment tax, which makes up for it. And if you have that, in other words, if you have positive income from your business, then you are going to owe this self-employment tax, and then you would add a Schedule SE to your tax return as well, in addition to the Schedule C. So the pros and cons of being a sole proprietorship: it's simple to set up and run. The income is taxed on your personal income tax return, so there's no separate tax return, and there's no double taxation that we'll talk about later when we talk about a C corporation. Any net operating losses you have can offset personal income. In other words, if the business loses money, you can use that loss to offset your other income. So maybe you have a job with a W-2, a salary, and on the side you have this business. If you lose money in the business, then you can deduct that basically from your salary, and now you have less income to report, and therefore you pay less income tax. And if you have a sole proprietorship, you can fully deduct your health insurance, and you can set up a retirement plan. The cons of a sole proprietorship are, again, the personal liability that you have, the income that you have, all of the income that you have up to the annual limit is subject to self-employment tax. And there are some fringe benefits that you may not be able to get with the sole proprietorship that you could get, for example, with a corporation. So now let's talk about partnerships. It is more than just one owner, but not incorporated. So this is basically like a sole proprietorship, except that you've got more than one owner. That's the way to think of a partnership. Again, there is nothing to file with the Secretary of State, and you might need to file that fictitious name or DBA again, and you might need a business license again, as with the sole proprietorship. It is relatively simple, although it is a good idea to have a written partnership agreement. It's not required, and it's not anything that you file with the state. So it is easy to set up a partnership. You just have two or more people that agree to start a business, and you have a partnership. But just from a legal standpoint, it is really a good idea to go ahead and have a written partnership agreement. The biggest downside to a partnership, again, is liability. And it's even worse with a partnership than it is with the sole proprietorship. Because if you are sued, just like with a sole proprietorship, your personal assets are at risk. But now you have to worry about things that your partner does in addition to things that you do. So if you are, let's say you've got two partners, you're equal partners. Even if you're not equal partners, it doesn't matter. You've got it, but let's just say you've got another partner. Now, not only can something you do get you sued, but something they do can get you sued. But again, a business insurance policy may be able to offset at least some of that risk. From a tax standpoint, a partnership does need to file a separate tax return, and it is Form 1065. A partnership is considered what we call a pass-through entity, meaning that the partnership itself usually does not pay income taxes. Instead, the profits or the losses are reported to each partner separately on something called a Form K-1, and then the partners report their proportion of the income or loss on their own Form 1040. So the profits are said to pass through to the partners. So they pass from the partnership, who doesn't pay income tax, down to the partners, who then do pay income tax. The partnership may or may not distribute its profits to the partners. In other words, it's up to the partnership and up to the partners whether or not they actually distribute any money out to the partners. But this doesn't actually change anything from a tax standpoint, because the partners have to pay taxes on the profits whether they are distributed or not. So let's say the partnership makes $50,000, and there's two partners and they're 50-50 partners. So each partner is going to have to pay income tax on $25,000, half of the profits. but the partnership may not actually distribute any of the profits. They might say, no, we need to keep that $50,000 in the business in order to expand or to buy equipment or inventory, et cetera, and so forth. So now the partners have to pay tax on $25,000 each, but they're going to have to get the cash to pay the tax from somewhere else because they're not getting it out of the business. So that's the way it works. The profits are taxed whether or not the cash is distributed to the partners. Another type of partnership, if you will, is something called a qualified joint venture. This is the one we said it is not a state law or common law entity, but it is a sort of quasi-tax entity. It's not actually an entity, but it receives special tax treatment. So this is what we're talking about. This is for two owners who are a married couple and they are not incorporated and they have no other state law entity. So this is basically a partnership between a husband and wife or between a husband and husband or a wife and a wife. It has to be a married couple and they have not gone to the state and set up an LLC or an LLP or any other type of entity. This allows them to treat the business as a sole proprietorship for tax purposes. So they don't have to treat it as a partnership and file a Form 1065. They can treat it as a sole proprietorship. Now, there are a couple other requirements, and that is that both spouses must materially participate in the business, and material participation is a concept that we talked about in part one when we talked about the passive loss rules. It basically means you need to work in the business a substantial amount during the year. So you don't have that one spouse works in the business and the other spouse is just a quote unquote silent partner who doesn't do anything or who doesn't do very much. They have to both be actively involved in the business. And then both spouses must also agree to treat it as a sole proprietorship. The qualified joint venture, again, nothing to file with the Secretary of State. And just like the other entities we talked about, the sole proprietorship and a regular partnership, you might want to file the doing business as, and you might want a business license. This is simpler than a partnership for tax purposes, again, because you don't have to file that separate tax return, but you do have the same liability as a partnership. So if you are sued for something you do or your spouse does as part of the business, then you can both be sued. And again, you can get business insurance to help mitigate that risk. The way a qualified joint venture is reported is unique. It is actually reported on two separate Schedule Cs or Schedule Fs if it is a farming business, but we'll just focus on the Schedule C to keep it simple. So what happens is each spouse reports their share of income and expenses on their own Schedule C. So you've got the spouses filing a personal income tax return. They could file jointly or they could file married filing separately. But either way, so let's talk about the more common situation, which is they file married filing jointly. Even though they are filing jointly, they will file two Schedule Cs for this business, one for one spouse and one for the other spouse. The good news is, though, there's no separate tax return, so they don't have to file a Form 1065 like they normally would if they were two unmarried people who were in business. The income is taxed at the personal income tax rates, of course. There's no separate income tax rates for this. If they have a positive income from the business, then they will owe self-employment tax. And then they will file separate Schedule SEs as well. So they'll have two Schedule Cs for the business, and they will have two Schedule SEs for the business. And so what this does is, again, self-employment tax is about Social Security and Medicare. And you may know that with our Social Security system, you get credit towards retirement for all of the time that you work. So by having two separate Schedule SEs, each spouse is getting their own credit towards their own Social Security when they retire. So that's why you want to have two Schedule Cs and two Schedule SEs. And then all of the income up to the annual maximum is subject to the self-employment tax. Next type of partnership is a limited partnership, or LP. This is a special type of partnership that has at least one general partner and one or more limited partners. This is something that you have to go to the Secretary of State's office and file the paperwork to form this limited partnership. And why do you do this? So the advantage here is that the limited partners are liable only for the amount they have invested in the partnership. So if the partnership gets sued, then the limited partner doesn't have to worry about their personal assets being at risk. It's only the amount that they actually invested in the partnership that they can possibly lose. So they are protected from being sued for more. Now, the general partner or partners, they are still liable and at risk. And remember, there has to be at least one of those. So you can't make everyone a limited partner. At least one entity or person has to be a general partner and therefore be at risk of being sued. But again, you can get a business insurance policy to help with that. This defaults to a partnership for tax purposes, though a limited partnership can elect to be taxed as either a C corporation or an S corporation if they are qualified. And we'll talk a little bit more about that later. Next type of partnership is a limited liability partnership, or LLP. This is a special type of partnership that is designed for professionals such as doctors, lawyers, accountants, and architects. In this case, each partner is protected against the malpractice or negligence of the other partners. So they're all partners, but in this one, so you can imagine here, if you're a doctor and one doctor commits malpractice on a patient, and of course they're going to get sued by that patient. Well, if you had just a regular old partnership, then all the other doctors would also be liable for that one doctor's bad action. So what a limited liability partnership does is it protects those other doctors from being sued for what the one bad action of that other doctor was. Now, in addition to having the limited liability, most states are going to say that you also have malpractice insurance. And of course, most of these professionals are going to have malpractice insurance anyway, but it will be required. And again, this must be formed under state law with the Secretary of State's office, and it defaults to being taxed as a partnership, though they can choose to be taxed as a C Corp or an S Corp if they want to. So the pros and cons of being a partnership. Well, the pros are it is relatively simple to set up and run. It is flexible in allocating profits and making distributions. So we're going to talk in a while about S corporations. And so a lot of times people try to decide between either having a partnership or an S corporation. That is a common decision point in businesses that are owned by multiple individuals. And one of the advantages of being a partnership as opposed to being an S corporation is that the partnership is more flexible in allocating profits and in making distributions than an S corporation is. A partnership is a pass-through entity, like we talked about before. So there is no double taxation like you might have with a C corporation. Any losses pass through to offset personal income. So again, if the business has a loss, then the partners, that loss gets passed through to them. They report it on their Form 1040 if they are individuals, and then they can use that loss to offset their other income. And the partners get what's something called basis for guaranteeing partnership loans. Again, this is different than with an S corporation, where S corporation shareholders do not get basis for guaranteeing loans of the corporation. Partners do get basis for guaranteeing the loans of the partnership. And why that is important is that can allow the partners to deduct some losses on their personal tax return that an S corporation owner would not be able to deduct on their personal income tax return. So again, it is comparing the partnership to the S corporation where that pro comes into play. The cons of being a partnership are that the general partners have liability and they can be sued, including their personal assets. The income that they get is subject to self-employment tax. The income is taxed whether or not it is distributed, as we talked about earlier. There are some fringe benefits that are not available to the partners or that they are taxable to the partners, even if they are available. And disputes between partners can be costly and time consuming. So we talked earlier about how it is a good idea to have a partnership agreement, and this is why. There have been a lot of relationships, friendships, family relationships that have been ruined because of a business partnership gone bad. So you want to have, as a best practice, a written partnership agreement in place that spells out what happens in every conceivable circumstance so that everybody's on the same page, they understand what they're getting into, and if something goes wrong, then they know how it is going to be handled. Again, not a requirement, however, a very good idea. Now let's talk about corporations. Again, a corporation is a state law entity that is considered a separate artificial person for most purposes under the law. It must be formed under state law with the Secretary of State. The owners are called stockholders or shareholders, and their liability is limited to the amount that they have invested. So this is really why corporations started, was to limit liability. People were tired of getting sued personally for what happened in their business. So the states came up with this idea of creating an artificial person that now they are the ones that are operating the business. And so if somebody is going to sue them, they have to sue the artificial person, the corporation, not the individual owners of the corporation, the stockholders or the shareholders. One of the big advantages also of a corporation is that they can raise capital by selling shares of stock. So I'm sure you've all heard of these IPOs, or these initial public offerings. This is when the corporations go out and they sell shares of their stock to the public, and they can raise a whole lot of money in order to run their business. So that's another big advantage of a corporation. Now, corporations do have the most paperwork and other administrative requirements of any of the different types of entities that we are talking about. So some examples of this: they have to have a board of directors, and those board of directors have to have regular meetings, and they have to keep minutes of those meetings, and they have to keep them all, they keep them in what we call the corporate book, is all the minutes of those meetings, and they have to have those meetings at least annually in most states. There has to be corporate resolutions to enter into certain transactions. So if the company wants to borrow more than some certain dollar amount of money, or if they want to make a purchase of greater than a certain dollar amount of money, they have to have an actual corporate resolution from the board that allows that transaction. They have to issue stock certificates, and they have to keep a logbook of all the people that they've issued those stock certificates to. And they have to make annual, at least, filings with their Secretary of State's office, and there are often fees associated with that. And you have to keep up all of these different things. You can't get lax with this. So a lot of times, especially a very small business, people will start a corporation because they've heard about it's good to protect them from liability, but then they forget about that they have to do all of these things, and they don't keep good records. And if you do that, if you don't keep up with all of this, if you don't keep up with what looks like a corporation, then a lawyer can come in and actually sue you personally. So if the business does do something and you get sued, the lawyer can say, well, they had a corporation technically with the state, but they didn't really act like a corporation. They didn't keep their corporate book. They didn't have a board of directors, and they didn't keep meeting minutes, et cetera, and so forth. And then they can do, it's called piercing the corporate veil. And then they can sue you individually as one of the owners. And so you have to make sure that you keep up appearances, if you will, by doing all of these things. For tax purposes, as we said before, there is no just corporation income tax. You are either a subchapter C corporation, what we call a C corp, or you are a subchapter S corporation or an S corp. By default, the corporation is taxed as a C corp. In other words, if you don't do anything else, you don't file any special forms with the IRS, and you have a corporation and you start doing business, then the default is that you will be taxed as a C corp. However, if you want to, you can elect to be taxed as an S corp by filing this form 2553. So let's talk first about a C corporation. A C corp is considered a tax-paying entity separate from its owners, and it files a separate tax return. It's a Form 1120. The corporation itself is taxed on its profits at a corporate tax rate of 21%. So remember, the corporation, a C corporation, is a separate taxable entity separate from its owners. So it is taxed separately from its owners, and it is taxed at corporate tax rates of 21%. Now, the corporation may, if it wants to, distribute its profits to its shareholders in the form of dividends. And I say if it wants to, there can actually get to a point where they are essentially required by the IRS to distribute those profits. But up to that point, it's up to the corporation whether or not they distribute those profits. However, when they distribute those profits, that's called a dividend, and that is not deductible by the corporation. So the corporation has its profits and they have their deductions. So they're doing their normal business. They've got their income, they got their deductions, but they cannot call this dividend a deduction. In other words, the dividend will not reduce the taxable income of the corporation, and it does not then reduce the corporation's tax liability. However, the shareholders do pay personal income tax on the dividends they receive. So if the corporation distributes out some of those profits in the form of dividends to the owners, then those owners, they pay income tax on those dividends. So that is, you may have heard about double taxation with a C corporation, and this is what they're talking about. The C corporation's profits, in effect, are being taxed twice. Once when they are earned by the corporation, and then again when they are distributed to the shareholders. So that is the double taxation that people talk about. There is a special type of C corporation called a personal service corporation, or PSC. It is sometimes formed as a professional corporation, or PC, under state law. And you will see this in the professions, such as accounting, actuarial services, architecture, consulting, engineering, health, including veterinarians, law, and performing arts. So again, you may see doctor's offices that are incorporated as a PC. So as with other C Corps, a PSC pays a flat rate, 21% of taxable income, and so therefore they are subject to double taxation, just like any other C corporation. It is also subject to the passive activity loss rules. They generally must have a calendar year for their taxable year. So a regular C corporation can choose any taxable year that they want, but a personal service corporation usually has to have a calendar year for its tax year. And a personal service corporation can elect S Corp status instead if they'd like to be taxed as an S Corp instead of as a C Corp. So what are the pros and cons of being a C corporation? Well, the pros are, again, liability protection. Secondly, they can have multiple classes of stock and an unlimited number of shareholders. So that is different than an S corporation that we'll talk about next. There are certain fringe benefits that can be provided tax-free to shareholders for a C corporation that are not allowed for an S corporation. Now, of course, those shareholders have to also be employees. So it's not just to any shareholder. But if you've got a small business where the owners are also employees, they can get some fringe benefits that are tax-free that an S corporation owner cannot get. And there is also the potential for a Section 1202 exclusion from gain on sale. So if you'll remember back to part 1, individual taxation, where we talked about this Section 1202 exclusion, this allows certain owners of C corporations, and we're talking again about small businesses here. So we're talking about a mom and pop type of C corp. If they meet certain requirements, and the requirements are very specific, so go back to part 1 and look it up if you're interested in this. But the owners, when they sell that stock of that qualified C corporation, can exclude up to $10 million of gain on sale. So there are people who, when they form their corporation, they keep it as a C corporation rather than an S corporation, specifically because they are anticipating selling that business someday at a large gain, and they want to take advantage of this 1202 exclusion from the gain. So that is a big potential pro to being a C corporation. So what are the cons or the disadvantages? There are high administrative requirements and fees, as we discussed before. You've got this whole double taxation issue. So the income is taxed twice, once at the corporate level and again at the personal level, the tax on dividends. Now, you may be able to avoid that double taxation. So there are strategies you can use as a small business owner of a C Corp in order to avoid the double taxation. You can do it by giving yourself a pretty good size salary. It has to be a reasonable salary, but you can give yourself a fairly large salary rather than taking the profits as dividends. Or you can have the corporation rent property from the owner, from the shareholders. So that's another way to get some of the profits out of the corporation to the shareholder. So the shareholder, for example, could own the building where the business operates, and then the corporation can pay the shareholder rent rather than paying a dividend. Again, it has to be reasonable rent. And we'll talk about all of this later when we get into the individual entity types. But the point is that there are some ways that you may be able to avoid some of this double taxation, but it is still a disadvantage of being a C Corp. Another disadvantage is that if the corporation has a loss, those losses are not passed through to the shareholders to offset their other income, like it would, remember, when we talked about a partnership, and like it also would when we talk about an S corporation. Capital gains in a C corporation that the corporation has are taxed at the same rate as all other income, which is 21%. And you may remember again from part 1 that normally capital gains for an individual are taxed at either 0, 15, or 20%. So you're going to pay more tax as a C corporation on capital gains than you would if you had an S corporation, for example, and those capital gains passed through to the individual owners, and then they would pay the capital gains rate at their individual tax rate. Also, any capital losses, again, are not passed through to the shareholders. They are kept at the C Corp level. So now let's talk about the S corporation. An S corp or small business corporation, they file a separate tax return. It is a Form 1120S. So you remember the C corporation is just a plain 1120. The S corporation is an 1120S. And it is considered a pass-through entity, much like a partnership, meaning it usually does not pay income taxes itself. The S corp itself usually does not pay income taxes. There are exceptions to that we will talk about in the S Corp video. So instead of the S Corp paying taxes themselves, like a partnership or very much like a partnership, the profits or losses are reported to each shareholder on a Form K-1, and then the shareholders report those profits or losses and pay tax on their own personal Form 1040. So in other words, the profits pass through to the shareholders. And again, like a partnership, the corporation may or may not distribute its profits to the shareholders, but it doesn't matter with an S Corp because the shareholders have to pay tax on those profits, whether or not any cash is actually distributed. So again, the shareholders may have to come up with cash out of their own pocket to pay the taxes on the profits if none of those profits are distributed to the owners. But any distributions that they do get are not subject to the self-employment tax, which may be an advantage over the sole proprietorship. So the pros and cons of an S corporation, you get the same liability protection as with the C corp, because remember, this S corp is just a tax concept. It's not a state law concept. So as far as your state is concerned, you're just a corporation. You're not an S corp or a C corporation. You're just a corporation. So you have the exact same liability protection, whether you are an S corp or a C corp for tax purposes. There is no double taxation with an S corp. The profits or losses pass through to the owners, so you don't have this situation where the corporation is paying tax and then the owners are again paying tax when it is on their own tax return when those dividends are issued. If there are losses, those pass through to the owners to offset their other income. And there again is no self-employment tax on the dividends. Now, if you have, let's say you have a small S corporation, you do have to pay the owners who are working in the business a reasonable wage. You can't just say, well, we're going to give you all dividends and not pay any type of Social Security and Medicare tax. You have to pay a reasonable wage. But any dividends that you do give above and beyond the wages are not subject to the self-employment tax. So that is a big advantage of an S corp over for instance, a sole proprietorship. The cons or the disadvantages of an S corporation: there's only one class of stock allowed. So you remember, with a C corporation, you could have as many classes of stock as you wanted. And with an S corp also, you can have a maximum of 100 shareholders. If you have a C corp, you can have as many shareholders as you want. You do not get basis for personally guaranteeing loans. So we talked about this with partnerships. With the partnership, you do get basis for personally guaranteeing the loans, which means then you can take more of the losses from the partnership. With a S corporation, the losses that you take might be limited if you're not able to personally guarantee your loans. It just depends on the personal circumstances. And again, we'll talk about all of that when we get into the individual entity videos. The personal tax rates are often higher than the 21% corporate rate. So remember, we said with a C corporation, the C corporation pays a flat 21% tax on their profits. And we said that with an S corporation, the profits pass through to the shareholders. Well, an individual shareholder, the highest possible tax rate for them is 37%. And remember, from part one, we talked about all the different tax rates leading up to 37%. So it is possible that an individual owner could end up paying more income tax because it's passed through to them than they would have if they had just had a C corp and paid the 21% corporate tax rate. And again, another disadvantage of the S corp is the income is going to be taxed to the shareholder whether or not it is distributed to the shareholder. And there are some fringe benefits that are taxable to shareholders, to any greater than 2% shareholder, that you would not have that issue if you had a C corporation. Next entity to talk about is a limited liability company. This is a state law entity that allows for liability protection that's very similar. I'm not an attorney. I think there are some nuances, but for all practical purposes, you get the same liability protection as a corporation without actually having to form a corporation and having all of the same formalities and paperwork and even expenses of having a corporation. So you don't have all, keeping the corporate book and having a board of directors and many of those other things that a corporation has. This must be formed under state law with the Secretary of State's office. The owners are called members. So you are a member of the limited liability company, and you can have only one member. Sometimes we call that a single member LLC or SMLLC, or you can have multiple members, a MMLLC, and there is usually no limit on the number of members that you can have. And remember, this is a state law concept, not a tax one. So there is no such thing as an LLC tax return. The LLC is going to be taxed as one of the other type of IRS recognized entities. So the default for a single member LLC is to be taxed as a sole proprietorship. The LLC in this case is considered a disregarded entity. In other words, you act like it doesn't even exist. So the owner simply files their Schedule C, just as if they had a sole proprietorship. Or if it's a farm, it would be Schedule F. Or if you're holding rental real estate in this LLC, then you might file Schedule E. But in any case, those are all filed on your Form 1040. Now, the LLC is treated as a separate entity for employment taxes and some excise taxes. But for income taxes, which is the main focus of this video and of the EA exam, it is a disregarded entity. And so for a single member LLC, it is taxed as a sole proprietorship. If you have a multi-member LLC, the default is for that to be taxed as a partnership. So then just remember what we talked about a partnership. You'd have a separate tax return, a Form 1065, and all of that. And any LLC can elect to be taxed as either a C corporation or an S corporation, as long as they meet the S corporation qualifications. And again, you do it by filing either Form 8832 to be a C corp or 2553 to be an S corp. So the advantages and disadvantages of an LLC: the pros, it has limited liability like a corporation. And probably the big one is that it is flexible from a tax standpoint. So this is one of the big reasons people choose an LLC. You can choose to be taxed as a C corp, as an S corp, or as a sole proprietorship if you're a single member LLC, or a partnership if you are a multi-member LLC. So this gives you a lot of flexibility, along with the limited liability of a corporation without all of the formalities and everything that you have to have with a corporation. And you can change the entity choice as the business matures. So let's say you've got a single member LLC, you can start out as a sole proprietorship. And then later on, you can decide, you know what, I think now it would be better if I were taxed as an S corporation, for example, and you can change and be taxed as an S corp. And then the fees and the paperwork and all the formalities are going to be lower than they are with a corporation. The disadvantages, the cons, is it's not as easy to raise capital as with a C corp. So with a C corp, you can have as many owners as you want, and you can issue all these different types of stock. You can go out into the stock market and issue stock. You can't do that with an LLC. So that's one of the disadvantages of an LLC compared to a corporation. Depending on which entity type you choose for tax purposes, some of the fringe benefits may be taxable to you as the owner or not available at all. And the fees and the paperwork are more than with a sole proprietorship or a partnership. So the fees and paperwork is an advantage compared to a corporation because there's less of it, but it's a disadvantage compared to a sole proprietorship or partnership because there is more of it. So now let's talk about changing the entity classification. I've mentioned several times already how you can have one type of entity that instead elects to be taxed as a different type of entity. And so if an entity wants to choose to be treated as a C Corp. So this is usually going to be an LLC that we're talking about. Although remember, limited partnerships and LLPs can also choose this, as well as personal service corporations. So it's not limited to LLCs, but I'm just going to keep it easy and think of it as an LLC because this is the most common case. So they can choose to be treated as a C Corp by filing Form 8832, Entity Classification Election. And keep in mind, a corporation cannot choose to be taxed as a partnership or sole proprietorship. So it doesn't work the other way around. An LLC or an LP or LLP, etc., can choose to be taxed as a corporation, a C Corp or an S Corporation. But a corporation cannot elect to be taxed as a partnership or as a sole proprietorship. In order to make this election to be a C Corp, it has to be made no more than 75 days after the requested effective date and no more than 12 months before. So let's say it's 2024 and you want this to be effective for 2024, you would have to do it within 75 days of January 1st of 2024 if you have a calendar year as your tax year, and you cannot elect it more than 12 months before January 1st of 2024. And in some cases, a late election may be allowed if you can show reasonable cause. Once you make this election, it generally cannot be changed for 5 years, for 60 months. So once you make this election to be a C Corp, you are kind of stuck with being a C Corp for the next 5 years. In order to elect S Corp status, and you're going to find that this is much more common than entities electing C Corp status. So in order to elect S Corp status, you don't have to file that 8832. You can just file this Form 2553, election by a small business corporation. So the S Corp election is done on Form 2553. It must be filed no more than 2 months and 15 days after the requested effective date or any time during the tax year preceding the effective date. So if you're talking about a calendar year entity, it has to be filed by March 15th of the year for which you want it to be effective. So let's say you want the S Corp election effective for 2024, you have to file it by March 15th of 2024. That is very similar to the 75 days that we talked about with a C corporation, but it is not exactly the same. The C Corp actually gets a couple of extra days because it's just 75 days. And since February is a short month, that actually gives you a couple of days beyond March 15th. But for an S Corp, it has to be by March 15th because it is 2 months and 15 days, not 75 days. And again, a late election might be allowed if you can show reasonable cause. And once this election is made, it generally cannot be changed for 5 years without IRS consent, although there are ways that you can revoke this election that we will talk about when we get to the S Corp video. Okay, now let's talk about getting started. So if you're first starting out a business, what are the different things that you need to do and to think about? So the first thing you have to consider is whether or not you even have a business. Do you have a business, or instead do you have a hobby? So if you have a hobby, then you can report your income minus your cost of goods sold, and you would report that on your Form 1040 as other income. But you would not report that, for instance, on a Schedule C because you don't actually have a business. You just have a hobby. Other expenses other than cost of goods sold are not deductible. You cannot report a loss. So if you have a hobby and you lose money, well, it's just a hobby. It's a personal activity you're engaging in. So you cannot report a tax loss. You don't have to file Schedule C or Schedule F, and you do not have to pay any self-employment tax. If instead you have an actual business, then you're going to report all of the income expenses. You could have a loss. You're going to report it on Schedule C or Schedule F, and you are going to pay self-employment tax. So this comes up a lot where people will have a business that has a loss, a quote unquote business. They will call it a business that has a loss. And then the IRS will step in and they will do an audit and they will say, no, you don't actually have a business. This is just a hobby. So they're trying to go after people who are trying to turn a personal hobby into a business in order to take a loss against their other income. They're trying to prevent that. So they have these rules that try to distinguish between what is a hobby and what is an actual business. So these are the factors in favor of being a business. You operate in a business-like manner and you keep books and records. The time and effort involved indicate your intention to make a profit. So you are committing a substantial amount of time and effort to this activity, whatever it is, that kind of indicates that, yeah, he or she really is trying to turn this into a business and make a profit. If you depend on the income from it for your livelihood, obviously, that's a good indicator that you actually have a business. If losses are due to circumstances beyond your control. In other words, if it's not just that you would expect to have a loss from doing this, like no reasonable person would actually ever expect that you're going to make any income from this, well, that wouldn't be a business. But if those losses are due to circumstances beyond your control, so for instance, all of a sudden there's a pandemic, a worldwide pandemic, and businesses are shut down, and you had a loss, that would be something that's out of your control. So that would be more in favor of it being a business rather than a hobby. You change methods of operation as needed to make a profit. So you're doing something, it's not working, you're not making money, and so you change what you're doing. That shows that this isn't just a simple pastime that you're doing for fun, but you're actually working and trying to make a profit. Do you or your advisors have knowledge to carry on the activity? In other words, this is a business you're getting into that makes sense based on your background or the background of your advisors. It's not just something you got into for fun on a lark, but it's actually something that was thought out and makes sense based on your life and on your life experience. Have you been successful with a similar business in the past? So if you've done this same thing before and you were successful, then probably you really are trying to have a business. Does the business make a profit? And how much profit does it make will play into whether or not it is a hobby or a business. And can you expect to make a profit from the business in the future from the appreciation of assets? So maybe you've got assets that you are buying, such as real estate, and that is part of it. And you expect that even though you have losses now, that in the future, that asset is going to become more valuable and you are going to make a profit. That could play into being a business rather than a hobby. There is a time when you are presumed to have a business, and the IRS will not argue with you that you have a hobby. If this business generated a profit in at least 3 of the last 5 years, including the current year. So if you look back for the last 5 years, if you had a profit in at least 3 of those years and this year, then the IRS will presume that it is a business. Any activity involving the breeding, training, showing, or racing of horses must generate a profit in at least 2 of the last 7 years, including the current year. So they are acknowledging here that it is harder to make a profit in businesses related to owning horses than in some other types of businesses. And so they're making it a little bit easier to qualify. You had to qualify in 2 of the last 7 years, including the current year. Even if you fail these tests, you might still be considered a business based on that list that we just talked about. But it's just that if you meet these tests, then the IRS is not going to argue with you and you're not going to have to look at those other factors. When you start a business, usually you will need to get an employer identification number. This is like a social security number for a business. And despite the name of it, employer identification number, you don't actually have to have employees in order to get an EIN. The only business that doesn't have to get one is a sole proprietorship that doesn't have any employees or pay any kind of excise taxes. So if you have a simple sole proprietorship without employees or owing any type of excise taxes, technically you do not need an EIN. However, from a practical standpoint, you want to go and get an EIN. Otherwise, you're going to have to use your social security number for everything that you do for your business. And that obviously is a big risk from an identity theft standpoint. So you and your clients, they want to get an EIN, but you need to know for the EA exam that the sole proprietorship that we mentioned does not technically need to get one. Now, the EIN is free. It's easy to get. You can get it online at irs.gov. You can get an EIN probably 10 or 15 minutes online. It is very easy to do. And again, it is free. If you are out looking to get an EIN and somebody wants to charge you money, that is a scam. Just go directly to irs.gov and look for EIN and apply there. If you want to, you can file on paper by filing this Form SS4. Business classification. No matter what entity type you have, doesn't matter if you're a sole proprietorship, partnership, corporation, whatever, you have to identify and report your business classification. This tells the IRS what type of business you are in. So it's a business activity code. It is a 6-digit number from the North American Industry Classification System, or NAICS. These codes are listed in all of the business return instructions for Schedule C, for Form 1065 for partnerships, for Form 1120 or 1120S for corporations. They are all in the instructions, so you can just look there and pick your code. They are also available on all the different types of tax software that you may have, and you just choose the most accurate code for your business, even if it's not exact. So there may not be something that precisely identifies your business, but you pick the closest one. And this is what those things look like. I'll zoom in here. It's still going to be hard to read. There are many pages of this. I'm just showing you the one page, but you can see for the different types of businesses, there's agriculture, forestry, fishing, and hunting. And then you've got very specific or more specific categories underneath that. Over here is manufacturing, and then there's food manufacturing and several different types of food manufacturing, beverage and tobacco product manufacturing, several different types, etc. So you just go through there and you find the code that best fits your business. Beneficial ownership information reporting. I'm including this in here, not because it's going to be covered on the 2024 EA exam, because this is not actually effective until January 1st of 2024. For the 2024 EA exam, as we said before, you're actually covering 2023 tax law. So this won't be on the 2024 exam. However, I recognize that some people might be watching these videos after that time. And also, this is just something you should know about if you own a business yourself or if you're working with clients. And so this is beneficial ownership information reporting. So most small business owners will have to file this report with FinCEN. That's the Financial Crimes Enforcement Network. This is a government agency. It's the same agency that administers the FBAR, which is the Foreign Bank Account Reporting System that we talked about in part 1 and that we will talk about again here. And the purpose of this beneficial ownership information reporting is to make it hard for people to hide behind corporations and other entities. So in other words, if you've got a business that's committing fraud, sometimes law enforcement has a hard time figuring out who is the actual human being behind these entities that are committing these frauds. So these fraudsters will set up corporations and LLCs and partnerships, and they'll have this whole web of entities so that it's very difficult to figure out who they actually are. So that if somebody wants to come arrest them or sue them, they are not able to find them or not easily able to find them. So this BOI reporting is going to make people who own these types of entities or who have influence over these type of entities report their individual information to the government. This was authorized by the Corporate Transparency Act, and it is effective January 1st of 2024. Existing businesses, in other words, the businesses who existed before January 1st of 2024, their deadline for filing this is January 1st of 2025. But for any new business that is formed on or after January 1st, 2024, including into the future, 2025, 2026, etc., they must report this within 30 days of formation. And this applies to any entity created under state law, such as a corporation, limited partnership, limited liability partnership, limited liability company, etc., as long as they are not exempt. So you may notice that the big exception that is absent from this list is just a sole proprietorship or partnership that is not filed one of those entities. So if you have a sole proprietorship and you never went and filed an LLC or a corporation, then you do not have to worry about this BOI reporting. Or if you've got a partnership that has never gone to the state and filed an LLP or a LP or LLC, then you do not have to worry about this. But if you have filed one of those entity types and you're not otherwise exempt, then you must do this reporting. And there is a list of exemptions, and you can find that on the FinCEN website. It's fincen.gov/BOI, but most small businesses are not on that exempt list. So if you've got a small business that has one of these entity types, you should just assume that you are going to have to do this. And this also applies to equivalent foreign entities that are registered to do business in any state by filing a document with the Secretary of State's office. So these businesses that have to file this, what they must do is they have to report the identity of the company itself or the entity itself. And for each beneficial owner of the company, their name, birth date, address, unique identifying number, which is basically their driver's license number or their passport number, and you have to provide a copy of the driver's license or passport. A beneficial owner is anyone who, directly or indirectly, exercises substantial control over the entity or owns 25% or more of the entity. So any 25% or more owner or any person, whether or not they're a 25% owner who exercises substantial control over the entity, must report. This is done electronically and only electronically through FinCEN's website, and there is no fee. So again, if you're out on the internet looking for this and somebody wants to charge you a fee, that is a scam. Don't fall for it. Just go directly to the fincen.gov website and file this. And it is not an annual report. This is a thing you do one time, and then you don't have to do it again unless there are changes. So if you have different ownership or a change in address or something like that, you do have to do it again. But there's no regular updating that has to be done, such as annually. There are penalties for not doing this, up to $500 per day to a maximum of $10,000, and or up to 2 years in prison for willful failure to file. Now, if you are an honest business owner or your client is an honest business owner who just didn't know about this or just forgot about it, then don't worry about these fines and possible jail time. FinCEN is not trying to fine or put into jail regular, honest business owners who just didn't know about this or who forgot about it. They're wanting to fine and put in jail people who are willfully not filing this. That's the bad actors out there who are not wanting to give this information. So if you did not meet these requirements, so let's say you had a business that existed before January 1st of 2024 and you missed the January 1st of 2025 deadline, or you started up a new business and you didn't file it within 30 days like you were supposed to, then that's okay. Just go ahead, get to that FinCEN website and go ahead and apply as soon as possible. Don't worry about these fines and prison sentences. Just get it done. And I will tell you, I did it for my own entity and it was very simple to do. Now, obviously, if you've got multiple owners or multiple people who have to report, it's going to be a little bit more complicated. But even then, that just takes a little bit more time. This really is a very simple process and very easy to do. Next, tax year. When you start a business, you need to choose a tax year for your business. C corporations can generally choose any month they wish to end their tax year. So their tax year does not have to end on December 31st. There are some entities that the tax year does have to end on December 31st, but a C corporation is not one of them. So you may have heard of this concept of the fiscal year. So you could have a C corporation whose year end is May 31st or August 31st. It doesn't matter. Any end of the month they can use as their end of their fiscal year. Now, it does have to be the last day of the month with one exception. You can have something called a 52 or 53 week year that ends on a particular day of the week each year. So, for instance, maybe you've got a fiscal year that ends on the last Friday in June. So that does not have to be on June 30th. It can be the last Friday in June if that is what you designate as your fiscal year. But other than that, it has to end on the last day of a month. There are certain entities, as I said, that have a required tax year. So some entities must use a calendar year. If you have an S Corp, a personal service corporation, you have to use a calendar year. Partnerships and LLCs must generally use the tax year of the majority of their owners. And I should mention here that as individuals, as we mentioned in part 1 of this course, individuals will have a calendar year. So if you've got a partnership or an LLC and all of the partners and owners are individual persons, then you must have a calendar year as well because you have to have the tax year of the majority of your owners. But there can be partnerships and LLCs that have, for instance, corporations. A C corporation could be a partner in a partnership or a member of an LLC. And the C corporation might have a different fiscal year, as we mentioned. In that case, that partnership or LLC would use that fiscal year instead of, say, a calendar year. Now, the IRS will allow exceptions to these requirements if you have a valid business reason, for instance, seasonality of the business. So if you want to do that, you've got a valid business reason, you can file this Form 1128 for an application to adopt, change, or retain a tax year. And then the IRS, they don't have to accept it, but they either will accept it or they will not, and they will notify you of that. Now, there's also something called a Section 444 election. So sometimes there's a business that would like to have a different tax year than they're supposed to have, but they don't have a valid business purpose. And so, for example, you could have an acquisition or a change in ownership that would normally require the entity to change its tax year. So let's say you had a business that has to have the same tax year as the majority of their owners. And so let's say they're on a calendar year, but then they get acquired by a C corporation that has a June 30th tax year. Well, normally that entity would now have to change to a June 30th tax year because you have to go with the majority owner, which is that C corporation. But you can request from the IRS, you can make this Section 444 election to keep the tax year that it already was. It was already, let's say, the calendar year. You can say, hey, we'd like to keep it a calendar year just to keep things smooth in the way they have always gone. Now, it could be for any other reason as well. It doesn't have to be because of an acquisition, but that's just a common reason that this happens. And so they can make this election, and then if it is approved, then the entity may have to make payments to offset the effect of any income deferral that the owners will enjoy. So you can't do this in order to try to save tax money. Like, okay, we will defer having to pay income tax if we change the tax year of this entity. So let's go ahead and change it. If you change the tax year and it results in a tax benefit to you, then you're going to have to make payments to make up for it, Section 444 payments. So you don't need to know the exact way that works, just understand that that is something that happens if you would have a tax benefit from making this change. A short tax year, if you have a tax year that is less than 12 months, that it is considered a short tax year. This most often happens when you are starting a business or when you are ending the business, though it could also happen from adopting a new fiscal or calendar year. So, for example, Jill forms Jill's Jewelry LLC on July 1st of 2023 and starts doing business that same day and elected to be taxed as an S corporation. So Jill's Jewelry, their first tax year begins on July 1st, 2023 and ends on December 31st, 2023. And their next tax year will start on January 1st of 2024. So that 2023 is considered a short tax year. Income tax return due dates. So we know that individual tax returns are due on April 15th. But what about business tax returns? For a sole proprietorship, it is due on April 15th. So a sole proprietor is a individual taxpayer. So just like any other individual taxpayer, their return is due on April 15th. A C corporation is due on the 15th day of the fourth month following the end of the tax year. So if you have a calendar year C corporation, it is due on April 15th, just like an individual would be. Now, there is one odd exception to this rule. If you have a C corp with a June 30th year end, then theirs is due on September 15th, which is the 15th day of the third month following the end of the tax year. So any other fiscal year, it is the 15th day of the fourth month, but for June 30th is the 15th day of September. So that's just a little interesting factoid, and it is something that could be tested on the EA exam, so you will want to know that. So the partnership and the S Corp are due on the 15th day of the third month. So that would be March 15th of the calendar year. So think about it this way. Let's just think about calendar years here for a minute, just to make it simple. If you have a partnership and you've got partners that are individuals, so those individuals, their tax returns are due on April 15th. The reason the partnership's tax return is due on March 15th is because, remember, the income from the partnership is going to pass through to the partners. So by making the partnership return due on March 15th, that gives the individual partners a month then to take the information from the partnership, incorporate it into their tax return. So they have to report the income from the partnership on their tax return. So it gives them a month to take that K1 and take that income and then figure out their own personal tax return. So the pass-through entities, the partnership and the S Corp, they are due on the 15th day of the third month. So for a calendar year, March 15th, in order to give the individual a month to file their tax return on April 15th. So the sole proprietorship and the C Corp, and again, the C Corp is an artificial person, so it is a taxpayer to itself, so it doesn't have this pass-through status. So the sole proprietorship and the C Corp, due the 15th day of the fourth month, and the two pass-through type of entities, a partnership and an S corp, are due the 15th day of the third month. Record keeping requirements. As it says there at the top, documentation, documentation, documentation. You need to keep books and records of your accounting transactions. Those will usually be in the form of ledgers, journals, entries, etc., showing all of your income and expenses. A lot of times we do this these days using various types of software, but it does not have to be. It can be by hand. You must keep the records and receipts to substantiate what is in the books. So you want to keep invoices, bank records, sales slips, paid bills, receipts, canceled checks, etc., to support the numbers that you have put into your books. These obviously can be kept electronically, or you can keep paper copies, and especially related to real estate and large purchases such as vehicles, machinery, and equipment. So a lot of times you can keep it electronically, but it's also good to have a paper copy of those things, and you will keep those in a safe place. But I cannot stress to you enough the importance of documentation when it comes to tax returns. If you are filing a tax return and you do not have good documentation, you are just asking for the IRS to deny all of your expenses and deductions, and to go and say, yes, we are going to tax your income, but we are not going to let you have any deductions. And so you're going to end up paying a whole bunch of tax that you would not otherwise pay. So when it comes to the IRS, always think about documentation. You must keep the records for as long as needed for the administration of the tax law. So under normal circumstances, the statute of limitations for an IRS audit is 3 years after the original due date of the tax return, or when the return was actually filed, whichever is later. So you're going to at least keep your records for 3 years after the return was filed or due to be filed, whichever is later. Any employment-related records must be kept for 4 years. And any records establishing the cost or basis of assets need to be retained until the statute of limitation expires on the year the asset is disposed of. So you could have a piece of property, of real estate, for instance, that you buy now and that you use in that business, and you don't dispose of that asset for 30 years. Well, you need to keep the records that shows how much that asset cost you for 30 years plus another 3 years to get past the statute of limitations. So you might have to keep those records for 33 years or more, depending on the circumstances. Commingling. You do not want to commingle personal and business funds. There needs to be a clear distinction between business and personal income, expenses, etc. And I will just tell you from experience, lots and lots of small business owners are not very good at doing this. They've got personal credit cards that they're using sometimes for personal, sometimes for business. They may even have bank accounts that they're using sometimes for personal and sometimes for business. That is a very bad idea. You should have separate bank accounts, separate credit cards, separate loans. Again, the IRS can come in and say, first of all, they can say, you're not actually being very business-like. You claim to have a business here, but do you really have a business? Or do you have a hobby? And then secondly, they can just start to say, you've got personal things in here, you've got business things in here. We're just going to say that all of this is personal. This is a personal credit card. We're just going to call it all personal. It's a personal bank account. We're going to call it all personal. And again, you could lose a lot of those deductions. So you want to keep things separate. And it also just looks suspicious to the IRS when you've got these things all mixed together. Speaking of things that can look suspicious, related party transactions. Related party transactions are not forbidden. I'm not saying you should never do them, but transactions between owners or their families or their other businesses, or between two or more businesses that are owned by the same people, they need to be very carefully conducted and documented. You need to be clear that you are doing things in a business-like manner and that you're not giving favoritism because you are related parties. So there should be a paperwork trail showing that the transaction was handled in a business-like manner. And even then, there are special rules. So throughout the videos, we're going to talk about some special related party rules. But just remember, anytime you've got a transaction between related parties, you need to be careful and you need to realize that that is going to be a red flag to the IRS. And so you want to, dot your I's and cross your T's and watch your P's and Q's and any other type of metaphor you want to use. You want to make sure that you are doing things on the up and up. Otherwise, the IRS can come in and reverse that transaction and just act like it never happened. And then there can be pretty severe consequences as a result of that. Okay, reporting requirements for businesses. So other than your tax return, which obviously we're going to be talking about tax returns throughout these videos, but other than that, rather than your regular tax return, a business can have several other reporting and record keeping requirements. So you can see listed there. We'll talk about each of these briefly. W-2s and W-4s and W-9s and 1099s, Form 8300 and F-bar. And there can be others as well. But the point is that as a business owner or as an advisor to business, you need to be aware of these things so that you don't miss something and end up getting penalized. So W-2s, you're probably familiar with a W-2. This is what you get if you have a job. At the end of the year, your employer sends you a W-2, a wage and tax statement. It is filed annually. It is for each employee. It reports their wages paid and taxes withheld along with other information. And these must be filed by January 31st of the following year. So you have to file it by January 31st for the previous year. And the employee gets their copies and the government also gets a copy. So this way the government knows what the employees received in wages, and then their computers can look for any mismatch. So if an employee doesn't report it on their tax return, then the government's computers will automatically flag it in order to audit that individual for not reporting it. A W-4 is an employee's withholding allowance certificate. So again, if you've ever had a job in the United States, you've probably filled out a W-4. So this is when you tell the employer, you give them all your name, address, social security number, etc., and you tell them how many exemptions that you might have. Now, this only needs to be done once, although the employee can fill out a new one at any time if they want to. If the employee does not fill one out, then the employer still has to withhold income tax, and they just have to treat that employee as if they are single with no exemptions, which that will give the maximum amount of withholding. The W-4 is not filed with the IRS. The employer must keep it, so they have to keep it in their files, but they don't have to send it to the IRS. Of course, the IRS can ask to review those, however, if they want to. A Form W-9 is a request for taxpayer identification number and certification. So a business may be asked to fill out a W-9 by another business, or they can ask another business to fill one out for them, or they can ask an individual to fill one out for them. So what a W-9 does is it requests that person's or business's taxpayer identification number, which could be a social security number or their employer identification number. And the reason they're requesting this is because that business is concerned that they may have to issue a 1099 to that individual or to that business. And we'll talk about 1099s here on the next slide. But if you think as a business owner that you may have to file a 1099 and issue a 1099 to someone, to another person or to another business, then you send them a W-9 to get their taxpayer identification number and their business or individual name and address so that you can then file that 1099. And again, these are not sent to the IRS, but they are kept in the business's files. So now we will talk about the 1099. There are various types of 1099s. One of the very common ones is a 1099 NEC, or non-employee compensation. So whenever a business pays $600 or more in a year to a non-employee individual or to a non-corporate entity for services performed, then that business must issue a 1099 NEC. So sometimes an individual will work for a company, but they're not actually an employee. So they'll do some sort of work, usually on a short-term basis, but it doesn't have to be short-term. But they're just not considered an employee. And we're going to talk about later in this video when you're considered an employee and when you're not. But for now, let's just take it for granted that the person is not an employee. If they get $600 or more, they don't get a W-2. If they were an employee, you would send them a W-2. Since they're not an employee, you're not sending them that, but instead you are sending them this 1099 NEC. Now, this can also go to non-corporate businesses. So if you have an LLC that is operating as a sole proprietorship or as a partnership, then they would also get a 1099 NEC for any work that they are doing for that business. Now, if that LLC instead has elected to be taxed, for instance, as an S corporation, then they don't need a 1099, because corporations, any corporation for tax purposes, you do not have to issue them a 1099. It's only non-corporations to which these get issued. So this is going to include things like bookkeeping or accounting. So if you are a bookkeeper doing business as a sole proprietorship for a business, that business has to issue you a 1099 if they pay you $600 or more. Could also be for legal services. Could be for your landscaper, your computer maintenance, cleaning, plumbing, electrical. If it is a non-corporate entity that is doing any type of work for you, then you issue them this 1099. Again, usually not required if the vendor is a corporation or taxed as a corporation. There are exceptions for this, but the main one that you'll come across is for attorneys. It doesn't matter if the attorney is a corporation, you still have to give them a 1099 NEC. These are sent to the recipient and the IRS again by January 31st of the next year. So just like a W-2, you have to do it by January 31st, send to the IRS and send a copy to the person to whom you are reporting. Another type of 1099 is a 1099 MIS, M-I-S-C, for miscellaneous information. This is for reporting $600 or more of rents, royalties, or other income to any individual or non-corporate vendor. Again, most commonly, it is used for rent, and you must send it to the recipient by January 31st. But you can send it to the IRS by February 28th if you're filing on paper, or March 31st if you're filing electronically. So this is an exception to the January 31st rule as far as reporting to the IRS, but you still have to send it to the recipient by January 31st. There are other Form 1099s that must be issued in specific circumstances. 1099 INT for interest, 1099 div for dividends, 1099B for broker and barter transactions, 1099C for cancellation of debt, and there are others. I'm not listing all of them. But if you file as a business 10 or more of these information returns in total, so you add up all your W-2s, all your 1099s. If you add up all of those, if it is 10 or more for tax year 2023, then you must file electronically. So those are filed in early 2024, but you must file electronically if you have 10 or more. Used to be 250, so they lowered it. So it used to be if you had 200 of these, you could file them on paper. Now you have to file those electronically. If you've got 9 or fewer, then you can file on paper instead of filing electronically. Next reporting requirement is Form 8300 to report cash payments of over $10,000. So if in the course of your trade or business, you receive over $10,000 of cash. So we're talking about actual greenbacks. Somebody's bringing in a bunch of $100 bills or 20s, or doesn't matter what the denomination is. But if you receive $10,000 of cash in a single transaction or a series of related transactions, then you must report those payments to the IRS. So if you are, like, for instance, you've got a car lot, a used car lot, you're selling cars, and somebody comes in and you're selling a car for $15,000 and they pay you $15,000 of cash, then you have to report it. And even if they pay you $5,000 one time and $5,000 another time and $5,000 another time, if it's all paying you for that car, then you have to add it all together. It's more than $10,000 and you must report it. This is filed within 15 days of the cash transaction. And you must also issue a statement to the party involved by January 31st of the following year. So you are sending it to the IRS within 15 days of the transaction. And then by January 31st of the following year, you are letting the individual from whom you received the money, you are reporting it to them. You are also allowed to file the form for less than $10,000 cash if it seems suspicious. So if you're sitting there and it just seems like the person brought in $9,900, so they're just under the $10,000 rule, but they gave you $9,900 of cash, and that seems a little fishy to you, and you're wondering if they're up to no good, and you want to, you can go ahead and fill out an 8300 and send it to the IRS. In that case, you do not send a statement to the party involved. Obviously, you don't want to let them know that you squealed on them, but you can file that form with the IRS if you so choose. FBAR, we talked about this in part 1. I am going to go over it again here in part 2 briefly, just to let you know and to remind you that this applies to businesses as well as to individuals. So if you have a foreign bank account, then you have to report if you meet these requirements. And again, this could be in your personal name, but also in the name of your company or partnership or what have you. So if you have a financial interest in or signature or other authority over at least one financial account that's located outside the United States, and the aggregate value of all of those accounts exceeded $10,000 at any time during the calendar year, then you must file this FBAR. So if you've got cash or other financial accounts, and at any time, not just at the end of the year, but at any point during the year, the aggregate value of all of those accounts was $10,000 or more, then you must file the FBAR. It is due on April 15th of the following year, but it is not an IRS form, so this is not something you file with your tax return. It's just due on April 15th. You can, though, get an automatic extension to October 15th, and you don't have to actually use a form to get that extension. This must be filed electronically. So we talked earlier about the BOI reporting through FinCEN that also had to be electronically. Same way with this. It has to be done electronically through FinCEN's system. And if you do not file, there is a $10,000 penalty for failure to file. And if you willfully fail to file, then it can be a larger than $10,000 penalty. Withholding and payments. If you are an employer, so if you've got any employees, one or more, then you must withhold certain amounts from the employee's paychecks. You will withhold federal income tax unless that employee is exempt, which can sometimes happen. But for the most part, you're going to withhold federal income tax, and then you are going to withhold Social Security tax and Medicare tax. So the total of those two is 7.65%. So you are going to withhold that from the employee's paycheck. Then from your own funds, so the employer has to pay from their own funds, not withheld, they have to pay the employer's share of Social Security and Medicare tax, which is another 7.65%. And they have to pay from their own funds federal and state unemployment tax. They may also have to withhold state or local income tax. So, not all states have an income tax, but if your state does have an income tax, then you're going to have to withhold state income tax. And some municipalities, like large cities, will actually have an income tax as well. And so you could have to withhold for that. Now, the EA exam is about federal taxes. So you're not going to be tested on withholding state and local income taxes, but you could be tested on withholding, for instance, federal unemployment tax. So just know there's withholding from the employee's checks, and then there are amounts that the employer has to pay from their own funds. Amounts that are withheld from the employees for income tax, Social Security, and Medicare, along with the employer's share of those taxes, must be reported and the funds turned over to the IRS in a timely manner. For reporting purposes, you have to report quarterly. So you use Form 941, which is the employer's quarterly federal tax return. Now, if you have less than $1,000 per year of all of this withholding and amounts due, then you can actually report annually on a 944. But the vast majority of businesses are going to report quarterly on the 941. So you're going to list on there the amount of wages that you paid, the amount of withholding that you had, and the amount of employer match or employer due amounts that you had. You report that every quarter. And these 941s are due on the last day of the month following the end of the quarter. So the quarter ends, for instance, March 31st, then that is due on April 30th. And then the next quarter is due July 31st, and then October 31st, and then January 31st of the following year. So that is for reporting the amounts due. The payments for the amounts that are due, they have to be paid more frequently than that. You must remit that money over to the IRS either monthly or semi-weekly, depending on your historical tax liability. So it's usually not paid with the 941. The 941 reports it, but the amounts paid are paid prior to the 941 being filed. These payments are made through the Electronic Federal Tax Payment System, or EFTPS. If you don't file on time, it can result in penalties of between 2% and 15% of the amount due. And then there also may be state reporting and payment requirements as well. Again, the EA exam is covering federal reporting and payments, but it's just letting you know you could have similar reporting and payments with the states as well. The trust fund recovery penalty. If these amounts that are withheld for Social Security and Medicare, those are called trust fund taxes, are not turned over, a penalty of 100% of the amount due can be imposed. If the business does not have the funds to pay it, any individual who acted willfully to withhold these funds can be made to pay. This individual can include officers, accountants, partners, or even volunteer directors can be made to pay these amounts. So this is a big deal. The IRS takes this very seriously and with good reason. If you look at the news, you watch the news, you will see fairly regularly, unfortunately, some business owner they withhold all this money from their employees, and then they go out and they spend the money and they never turn it over to the IRS. And the ones that you're seeing in the news are the people who are getting caught, and they typically are going to prison. So people go to prison for this. And in addition to that, the money has to be paid by someone. So remember when we said if you've got an entity that the owners have liability protection? Well, you don't have liability protection for this. For this, the IRS can go after the individuals, and they don't even have to be owners. They could be anyone in the business. If that person acted willfully to not pay these funds over, they can personally be liable for paying them. So that is a very big deal. self-employment tax. Self-employed taxpayers are considered both the employer and the employee for payroll tax purposes. We talked about this in part 1, so this is just a reminder. So if you're self-employed, you're not having Social Security and Medicare withheld from your paycheck. So you have to pay into Social Security and Medicare somehow. So the way you do it is through the self-employment tax. So you are going to pay both the employer and the employee's portion of Social Security and Medicare. That equals 15.3% that you are going to pay in. So the self-employment tax is 15.3% of your net income from self-employment. However, it is limited. And for the 2023 tax year, which is what we're talking about here for the 2024 EA exam, that limit is $160,200. There is no limit for the Medicare portion. So that is the limit for the 12.4% Social Security piece. There is no limit on the 2.9% Medicare piece. And that $160,200 goes up each year with inflation. So the IRS announces that. You can go to irs.gov to see what that amount is for whatever year you are concerned with. The self-employment tax is reported and paid on the individual's personal 1040 on Schedule SE, but they do get an income tax deduction for half of the self-employment tax. So in other words, they're getting a deduction for what would be considered the employer's share of that self-employment tax. Because if you think about it, a business, when they have to match withholding for Social Security and Medicare, they have to match that 7.65%. That match is a deduction to the company. So this is just putting the individual on the same footing as that business and giving them a deduction for the employer's share of that self-employment tax. Federal unemployment tax. Employers generally must pay 6% of the first $7,000 of wages per employee per year for the federal unemployment tax. So any employee that you pay, you have to pay 6% on their first $7,000 of wages. And of course, you could also have state unemployment tax, but that's not part of the EA exam. You must pay these amounts by the last day of the month following the quarter. So just like with the 941, it's April 30th, July 31st, October 31st, and January 31st. Only this is when you actually pay it in, is you pay the unemployment tax in on those dates. And then you must file this Form 940 annually. So it's an annual report, but you pay in quarterly. Sales tax. As a business, you may be responsible for collecting and turning over sales tax. However, that is a state and local income tax. It is not tested on the EA exam. Just want to make sure that you don't forget about it and that you do take care of that with your state or local authorities. Now we will move into worker classification. This is the last topic in this video, and it has to do with whether people who do work for a business are employees or independent contractors. So businesses must withhold and pay payroll taxes for employees, as we have just talked about. But they do not have to withhold or pay any payroll taxes for independent contractors. So what this means is that the business has an incentive to designate people who work for them as independent contractors rather than employees. So a business could save a whole bunch of payroll tax money if they just called everybody who worked for them an independent contractor rather than an employee. And the IRS knows this, and there are business owners who try to do this. And so there are rules in place to try to distinguish between who is an employee and an independent contractor. So there are guidelines. Unfortunately, it is not always a black and white decision where you can just easily see, oh, if you meet this, you're definitely an employee, and if you meet this, you're definitely not an employee. But let us look at those guidelines. The classification is going to depend on the facts and circumstances of each particular case. And it all hinges on the degree of control the business has over the worker. So there are three main areas to consider when we're talking about the degree of control: behavioral, financial, and the type of relationship. From a behavioral standpoint, the question is, does the company control or have the right to control what the worker does and how the worker does his or her job? From a financial standpoint, are the business aspect of the worker's job controlled by the payer? This includes things like how the worker is paid, whether or not expenses are reimbursed, who provides the tools or the supplies that are used in doing the job. And then the type of relationship. So are there written contracts or employee type of benefits? So is there a pension plan or insurance or vacation pay, etc.? Will the relationship continue, and is the work performed a key aspect of the business? So those things are all considered. If you are not sure which is correct, the business or the worker can file a Form SS-8 with the IRS, and the IRS will make the determination for you. So you fill this form out, you kind of describe and check boxes about the various aspects of the role, and then the IRS will make a determination for you. If a worker is classified as an independent contractor and they disagree, the worker thinks, no, I should be an employee, they can file a different form, a Form 8819, and then the IRS will look into this on behalf of the employee. So you, again, if you watch the news, you may have seen many of these cases. This is an often litigated issue that comes up. The IRS will sue the employer, or sometimes it's not even the IRS, it's the Department of Labor, but some government agency will sue the employer and say, you are incorrectly calling these people independent contractors. They should be employees, and therefore, as employees, they are entitled to all of the benefits of being an employee. And as an employer, you are required to act as an employer and to withhold the taxes and to pay payroll taxes that you are supposed to pay and to provide these employees with various benefits that you are required to provide to employees. So there are a lot of big cases that involve millions and millions of dollars involving just these types of issues. And the penalty for misclassifying employees as independent contractors could include being held liable for employment taxes for all the past work going back years and for other employment related costs and penalties. And as we said, it's very controversial and frequently litigated. There are some people who are considered statutory employees. In other words, they are automatically classified as statutory employees and they get a W-2, and Social Security and Medicare taxes are withheld, and the employer has to match the Social Security and Medicare taxes. However, even though they get a W-2, they report their income and expenses on Schedule C. So it's kind of a hybrid situation where you are an employee for payroll tax purposes, but you're an independent contractor for profit and loss purposes. So they file a Schedule C, but they don't owe any self-employment tax because they're already having Social Security and Medicare withheld. Examples of statutory employees: route drivers, such as beverages other than milk. So the milkman can't be a statutory employee, but meat, produce, bakery products. If you're a route driver and you are an agent who works on commission, that would be an example of a statutory employee. A full-time life insurance sales agent, statutory employee. An individual who works at home on materials or goods that the business supplies. So the business sends the person some materials and says, here, put together this widget, whatever it is, be a statutory employee. A full-time traveling or city business-to-business salesperson who sells merchandise for resale or supplies. So this is, you've got a business that sells to other businesses, and this person is a full-time salesperson, and that's what they're out there doing, they could be considered a statutory employee. There's also a statutory non-employee. So some workers are automatically classified as non-employees. So in other words, they are considered self-employed for federal income and self-employment tax purposes, and they are done so automatically. There will be no argument from the government. There are three categories of these: direct sellers, licensed real estate agents, and certain companion sitters. So direct sellers and licensed real estate agents qualify if substantially all of the payments for their services are based on sales or other output rather than hours worked. So they're getting some kind of commission, not an hourly type of wage. And their services are performed under a written contract, providing that they will not be treated as employees for federal tax purposes. So they're getting paid based on commissions, and there's a contract between them and the company that's paying them that says, I understand that I am not an employee and I am an independent contractor. For companion sitters, the rules are a little bit different. This is for someone who provides personal attendance, companionship, or household care services to children, the elderly, or the disabled. A business who puts such persons in touch with clients will not be treated as an employer. So this would be like an agency that matches companion sitters with people who need companion sitters. So they will not be considered an employer if they don't receive payment or wages for or pay the companion, and the business, the agency, is paid by the companion or the client on a fee basis. So if the agency is just taking a fee, then they are not considered to be an employer. So that is the end of video 1 of part 2. I will see you on video 2.